So here are the top investment opportunities in Dubai real estate for 2026 regarding the communities, ROI and the roadmap. What if you could buy into Dubai community today, and by the time the area fully matures, your property is delivering strong capital growth and high rental income? That's not a fantasy. We have already seen communities deliver triple-digit capital appreciation after handover cycles. Now, the real question is, for 2026, where is the next smart entry, by which community, and what will be the strategy? So let's set the base with real market signals. Dubai has recorded over 761 billion dirhams in property transactions in 2024, with around 226,000 transactions, the highest volume on record, showing 36% growth in volume and 20% growth in value year on year. On top of that, Dubai is pulling growth wealth. The UAE welcomed 6,700 millionaires in 2024, and 2025 projections suggest 9,800 more relocating in. More high-income residents means more end-user demand, and in Dubai, end-user demand is what keeps price supported. Dubai is also tracking towards 7.8 million residents by 2040. Today, the city is around having 4 million population. More people means more housing demand, and the biggest winners are the communities that sit close to the jobs, lifestyle hubs and infrastructure. So here is the rule number 1. Buy within 15-20 minutes of a business hub. Here is a simple filter that works in every cycle. If your property is 15 to 20 minutes from a major business hub, it has a higher chance of staying liquid. That means easier resale, stronger rental demand and better long-term pricing. So now let's break 2026 opportunities by community categories. Number 1. High real apartment communities near business and tourism hubs. If your focus is rental income plus steady demand, look at mid-market communities that sit between business districts and tourism zones. Key communities clusters like JVC, JVT, Arjan, Sport City, Motor City. These communities connect into employment zones like JLT, Media City and Internet City, while still being positioned within reach of lifestyle zones like Dubai Marina and JBR. Why this matters in 2026? Supply exists, demand is consistent, and your tenant pool is wide. JVT is often considered an underestimated pocket, and the key point is that when an area shifts towards more retail, services and family convenience, it improves rental stability. ROI in this zone has been around 7 to 8.5% depending on the pricing and the unit selection. Now investors, please note, in apartment communities, you will win by choosing better layouts, less road noise, exposure and the building with amenities that actually attract tenants. Second is business heavy rental communities. If you want more corporate tenant profile, look at communities where jobs are dense. For an example, JLT. The logic is simple. High company concentration means consistent leasing demand. But the strategy here is specific. In mature communities, don't buy blindly. Pick better product quality, views, strong developer track record, because older stock can pull average rent down. While if I talk about the newer buildings, price may vary differently. Third is undervalue proximity communities near to the central hub. Now let's talk about the communities that win because they are close to the city core without the full downtown price tag. Example, Maidan Horizon. The key value proposition is proximity, which is roughly 7 minutes from downtown. These areas are positioned to benefit from central connectivity, lifestyle development and future infrastructure. If the area goes through a full maturity cycle, it tends to compress the pricing gap versus nearby prime districts. Communities like this can be strong for Airbnb demand and long-term rentals, but selection matters. Views, master plan direction and developer qualities are critical. The fourth point is infrastructure aligned growth corridors. Now if I talk about Dubai's 2040 direction is one of the most important investment anchors. The plan focused growth around major urban centers and improves liability. What I mean by that is like having daily needs within a short walking radius. The biggest infrastructure catalyst is the transport. The Metro Blue Line is 56 billion dirhams project around 30 kilometers with 14 stations targeted for September 2029. Historically, properties near new metro stations have seen value appreciation once line becomes operations, in some cases up to 25% uplift. So communities tied to future connectivity, especially those gaining direct links towards key nodes, are worth watching for 2026 entry. Now comes the fifth point, which is family segment, townhouses and villas. Now the segment that keeps coming up, that is families. Dubai household formation has been outpacing population growth in recent years, and villas and townhouses generate outsized rental value. Villas and townhouses represent about 33% of rental transactions but contribute around 58% of total rental value, meaning larger homes command stronger rental share. The argument is simple. If Dubai keeps attracting families, the demand pressure stays on 3 to 5 bedroom layouts, especially in master plan communities that offers schools, parks, daily convenience. So if you want a clean 2026 roadmap, here it is. For ROI and rental stability, focus on communities near to business hubs like JVC, JBT, Arjan corridors and similar rent demand zone. For corporate leasing demand, look at business dense communities like JLT, but choose product carefully. For capital growth, potential target communities close to the core that still have room to mature like Medan side districts. For long hold wealth building, don't ignore townhouses and villas communities. Family demand is a long-term driver and across everything aligns with infrastructure and 2040 growth direction, because city rewards the people who enter before the crowd and sees the full picture. Thank you for watching this video. If you want to know more about Dubai real estate investment, please subscribe to the channel.